Interest rates are going down, but the economy is still good. So the news is often talking about the interest rates and how the interest rates are coming down and how Trump wants to do negative interest rates. But there's actually still a lot of people who don't really understand interest rates or how they affect the economy and what's the point of cutting interest rates. But the interest rates actually have a lot of effect in the economy and in GDP. Where to start? So the Fed is essentially the central bank, and they kind of set the national interest rates. Commercial banks follow suit with whatever the central bank decides to set the interest rate to. Now, the commercial banks don't necessarily have to follow suit with the central banks, but most banks believe that it's in their best benefit to do so. So since the Fed has been cutting national interest rates, the commercial banks have been doing so as well. So banks in general, they need to have a certain amount of funds in at the end of the day. And the amount that they need to borrow, they get charged an interest rate for it. So if JP Morgan are short a certain amount of money at the end of the day, they borrow money from the central bank and they're charged whatever the interest rate is. So when the interest rate is lower, that means that JP Morgan, they can cut their rates. It's a good opportunity for investors, potential home buyers, or people that are looking to start a business. It's a good opportunity for them to make these loans because they're much more cheaper to do so. So just any loans in general, it will get more cheaper because the banks, they can afford to charge less for it. But alternatively, people's savings accounts, the yield that they get on those savings accounts go down as well. So I use Wealthfront, and they used to give me around 2% on annual interest, but after the rate cuts, they only yield around 1.82% or so. So right off the bat, loans are now cheaper. But the downside, however, for consumers is that now their savings account is giving them less money. So why does the Fed want to cut the interest rates? Okay, so I mentioned that cutting the interest rates would lead to less yield in savings of bank accounts. So when the interest rates are lowered, people will hoard less of their money because they're not yielding as much in their savings accounts. So this kind of encourages them to spend their money. So this kind of affected me the same way, because since I'm not yielding over 2% of annual interest anymore, it gives me more incentive to take out some of that money to reinvest it or to spend it on certain things. So basically what cutting interest rates is, it's a tool that is used by the Fed to drive up demand or to drive up consumption of goods or investments. And this kind of helps the economy, say, just keep on moving along. But alternatively, it means that people aren't spending enough money or investing as much, which is not good for GDP, because a large part of GDP is driven by investments and consumption of goods. And when there's not much consumption of goods, this signals to companies that there's less demand of their products. And so what companies will do, they'll start cutting back labor. They'll start scaling back production. So they'll produce less goods. So that means people could start getting laid off, or they'll start getting less hours. And this is bad for unemployment because unemployment will go up since there's less demand for labor. So essentially, cutting the interest rates is meant to help curb all these things. But it's also a signal that the economy is not as strong as it seems. Because essentially, in a stronger economy, the interest rates should be rising. So this signals that there's plenty of investments and consumption of goods going on in the economy. And there's less need for people to spend that much. Because when you cut interest rates, since there's a new surge of demand of, say, goods and more investments coming in, inflation will arise no matter what. So therefore, raising the interest rates is also used by the Fed to curb inflation, so that there's not an over-excessive amount of spending in the economy. Inflation will occur no matter what. It's fine as long as it's controlled. And the government has been trying to control inflation by keeping it around 2% at a minimum. Now, what Trump wants to do is to go to negative interest rates. And with negative interest rates, so whatever money that you're depositing, you'll be charged a fee for it now. Since with positive interest rates, you yield a certain amount of money whenever you store money with the bank. With negative interest rates, you're going to be charged a certain amount. And as I said before, the interest rate cuts is meant to drive up demand and to make people spend more money. But also, like I said, there's also a good deal of inflation that will come along as well. Especially when you cut interest rates to such a big degree. So when you're cutting the interest rates, there are both positives and negatives. But ultimately, it's a signal that the market is not as strong. The last time we had to cut the interest rates was during 2008, which was the recession. So essentially, the rate cuts is basically a band-aid. It's only a short-term fix. Alright, so that's pretty much it. If you enjoyed, like and sub.